financial statement analysis, and method statement analysis also we completed. So after that, we discussed that ratio analysis and funds flow analysis and cash flow analysis. We discussed about the entire theoretical part, and illustrations also are given. And last calls also I discussed about the marginal costing and budget and budget control. Only the classes left, that is standard costing and variance analysis. So today I'm going to talk about the standard costing and variance analysis. Okay. Standard costing and variance analysis I'm going to explain now. Just wait. I'll explain. I will share the PPT. Yeah, right. Sorry. Okay. What is the meaning of standard costing? So now we are going to discuss about the last unit, last block, that is the first unit in last block, standard costing. So what is the meaning of standard costing? So standard is a predetermined benchmark or target. So in the cost accounting, it represents the expected cost under the efficient operating conditions. So here we are going to compare in the standard costing, whatever the actual cost is there, whatever the expected cost is there, we are going to compare the between this expected cost and actual cost. So standard costing is nothing but a predetermined benchmark of target costing. So in cost accounting, before production, before producing of something, so we are going to estimate the what is the approximately cost, what is the cost incurred. So that is nothing but a expected cost. So estimation, it is also called as a estimation cost. So standard means what? It is a predetermined benchmark or target costing. In cost accounting, it represents the expected under the efficient and operation conditions. So what is the meaning of standard costing? So standard costing refers to the estimated cost or estimated cost of product or service based on the expected prices or usage and efficiency. So standard costing means what? It is refers about the estimated cost. It talks about the estimated cost. Either it may be product, either it may be service. So based on the expected prices, what is the usage and efficiency we are going to expect. So it acts as a yardstick against the which is actual performance of measured. So this is the meaning of standard cost. And standard cost meaning generally, we are going to use the cost controlling techniques. Here we are going to involve the cost controlling techniques. So what is the cost controlling techniques? Setting the standard costs for the products or operations. First of all, we are going to set the standard cost and measuring the actual cost, whatever the cost is incurred, original cost is there. So whatever that incurred actual cost, we are going to measure. After that, comparing the actual cost, comparing the actual cost with the standard costing. And then after measuring that, we are going to analyzing the actual cost and expected cost. So that is corrective mean only we are going to take. What is the steps going to be involved in the what are the steps involved in the establishment of standard cost? First, we need to define the objectives of the cost control, decision making, etc. purpose. And after that, defining of the objective, after we need to classify the cost. So the cost, whatever the cost of elements are there, whatever the material cost is there, whatever labor cost is there, whatever over cost is there, that class based on the elements of cost, the cost are we are going to classify. Then determine the standard quantities and prices. So for each component, either it may be material, either it may be labor, either it may be overheads, we have to determine the standard quantities and prices of the element wise. Like standard, for example, standard material cost is there. What is the standard quantity? What is the standard price is there? After that, labor variance is there. What is the standard hours? What is the standard rate is there in labor hours? So like that, we are going to determine the standard quantities and prices before establishment of the standards. After that, consulted departments involved in the production and purchase the HR. So consulted means what? Involve the production and purchase the purchasing on HR. So fix the responsibility, assign the cost centers and accountability. So it means what? We are going to give the targets, we are going to assign the responsibilities to the particular cost centers and review the revise. So update the standards periodically and reflect the changes. So this means, so after once the calculation is completed, once the estimation is completed, we have to compare the both actual cost and standard cost. So what is the difference between standard costing and budgetary control? So budget control is different, standard costing is different. So standard costing mainly it is going to the scope of the difference of scope. So generally standard costing only mainly cost per unit. To calculate the cost per unit, to know the cost per unit, standard costing is we are going to do. But whereas budget control is not like that. It is deals with the overall financial planning. So here individually unit wise we are going to concentrate. Here budget control, here we are going to concentrate overall financial planning. And application where standard costing is going to apply, where budget control is where going to apply. So generally applied most in the standard costing production and cost centers only. But in case of budget control, it applied for all the departments. And nature of the control. Nature of the control. More details and specific. Standard costing talks about the more detailed and specific. And budget control talks about the more broad general. And variancy. So in standard costing, detailed variance analysis is done. And budget control, limited, no detailed variance analysis is done. So only variance analysis done in the standard costing only. In budget control, we are not going to be concerned. And flexibility. In standard costing, very less flexibility and based on efficiency assumptions, we are going to calculate. But in case of budget control, it is more flexible. It can be adjusted with the business value. So according to their requirement, they can adjust also. So what are the types of standards? So ideal standard, attainable standard, basic standard, and current standards. So this is not required. Now, let us discuss about the first one is the in standard costing. First one is the material cost variance. So what is the material cost variance is there? So here in this black, we discussing about the only theoretical part, that is meaning of standard costing. Standard cost meaning steps established in standard cost and difference between standard cost and budget control, types of standards, ideal standard, attainable standard, basic standard, and current standards. So again, I'm going to explain that ideal standard means what? It is assumed that perfect condition, there is no wastage, 100% efficiency. So ideal standard means what? So without any wastages, 100% give the we are going to give the 100% of effort, 100% of effort. So next one is the attainable standard. So based on the practical and efficiency conditions, achievable under the normal working conditions. So whatever the normal working conditions we are going to achieve, that is the attainable standard. And the basic standard. So long-term benchmark standard. This one is nothing but a long-term benchmark standard. It is used for the comparison over a period of time and not revised the frequently. So next one is the current standard. Current standard talks and reflects about the present conditions and market prices. Generally, this standard is regularly going to be updated. What is the advantages of the standard costing? Generally, when you use the standard costing, it will help to cost control. So helps in identifying the reducing of inefficiencies. So where is which department is the inefficient, who is inefficient, so how we effectively using this all are we are going to use and simplify the costing. So the standard costing facilitate easier cost comparison, and that variance analysis management can be focus on problem area. Focus on problem area, and the performance evaluation employees and departments can be evaluated based on the standard performance. So next advantage is budget preparation. Support preparation for the realistic budgets. And inventory valuation. Simplify the valuation of the stock and work in a progress. Work in a progress. So these are the advantages of the standard costing. What is the limitation of standard costing? So generally limitation of standard costing, it is not suitable for all. So generally it is only applicable for the job or service, for a particular service or particular job only. It is not suitable for the entire organization. And this high setup cost. So standard costing requires, it involves the high significant time. So involves a significant time and resource investment and frequent changes also. So required to frequent updated and standards due to the price fluctuations. So it may be discourage the innovation. Sometimes standard costing will not going to be encourage the innovation side. So it may be discouraged also. And accuracy issues. So inaccurate standards leads to the misleading and variancy analysis. Sometimes whatever the data we are taking, we are analyzing according to the estimation. So maybe that some going to mislead also. So this is the limitations of standard costing. Now I'll discuss. Now I'll discuss that different types of variancy analysis. What are the variancy analysis are there? So that all the what is the formulas. So what is going to discuss in the variance analysis, that all we are going to discuss. Right. Yeah, variancy analysis. Variance analysis talks about the variance analysis talks about the meaning of variancy. First of all, what is the meaning of variancy? So variance is the difference between standard cost or standard revenue and the actual cost or actual revenue. So variancy means what? It is a difference. So difference between what? Standard cost or standard actual cost or standard revenue or actual revenue. So whatever the difference is there, that is called as a variancy. So variancy we can calculate the difference between two variables, that is standard and actuals. So either it may be cost or either it may be revenue. And what is the variancy? Variancy can be, that variancy can be two conditions we are going to observe. So it will give the two conditions, that is favorable situation and unfavorable situation. What is the favorable situation? What is the unfavorable situation? When actual cost is less than the standard cost or actual revenues are more than the expected, so it is favorable. So it means what? So actually you estimated some service cost or product cost, that is 1,000, but the standard costing is only 80 rupees. So your actual cost is sorry, your actual cost is 80 rupees, 100 rupees. Standard cost is, for example, standard cost is 100 rupees. So when you estimated your actual cost, when it is less than the standard cost, that is favorable. So similarly, revenues are more than the expected. Actually, your actual revenue uh, is more than the your received standard revenue. So that time also it is favorable. And what is the unfavorable situation? When the actual sale is more than the standard cost, or when the actual cost is more than the standard cost. It is exactly opposite. So before favorable situation, what happened? Actual cost is less than the standard cost. But here unfavorable situation is what? Actual cost is more than the standard cost. So that situation is unfavorable. So it can be measured in terms of revenue also. That is actual revenue less than the expected revenue. So what is the various types of variance analysis are there? So generally, that variance analysis, it is there in the material variance, material, labor, and sales variancy, sales overhead variancy. Okay. So these are different variances are so there. So that is overhead variancy. So again in sales variancy, generally we are going to discuss four types of variances. First one is the material variancy. What is the material cost variancy? So as we earlier, whatever we discussed that material cost variancy, the difference between material cost actual, whatever they incurred and whatever the standard material cost is there. So expected material is there. So that difference is called as the material cost variancy. So to calculation of material cost variancy, we are going to use this formula, that is standard quantity into standard price minus actual quantity into actual price. So this standard quantity and standard price is nothing but a material cost variancy, that is standard cost price, and this is actual cost variance, actual cost price. So standard quantity into standard price, the standard cost variancy, and difference of that actual cost and actual price. So that is called as a material cost variancy. It measures the overall differences of the material cost. So material cost. Second one is the material price variancy. To show the variance due to the price differences. To shows the variance due to the price differences, we are going to use the material price variancy. That to calculation of material price variancy, we require that standard price, the difference of the price, that is nothing but a standard price minus actual price. So we are going to multiply with the actual quantity. So that is called as a material price variancy. So price variance we have to take, then we can multiply with the actual quantity. You will get the material price variancy. So this material price variancy shows that price differences. Next one is the material usage variancy. See, previous variancy we talking about the price variancy. Means what? Price differences we taken. And here we are going to take the quantity differences. The quantity differences, how we are going to show that, how we are going to see, take that, how we are going to take standard quantity minus actual quantity. So after calculation of the difference of quantity, we are going to multiply with the standard price. So this will give the result of material usage variancy. So material usage variancy shows that variancy due to the excess or efficient usage of the quantity. So this is the material usage variancy. Next one is this material usage variancy also. Generally, two situations we are going to do that. When the standard quantity is equal to the actual quantity, that is we are going to take. And when the standard quantity is not equal to the actual quantity, so that time the standard going to multiply, we are going to convert into actual quantity proportionate. Then we can calculate the material usage. Next one is the second variance is labor variancy. Labor variancy talks about the labor cost variancy, labor rate variancy, labor efficient variancy, labor efficient variancy. So same, this is also very similar to the material cost variancy, but in this case, instead of material, we are going to take the labors. Instead of material price, we are going to take the labor rate per hour cost. So first we are going to calculate the labor cost variancy. Labor cost variancy, how we are going to calculate? Standard hours into standard rates minus actual hours into actual rate. So material cost variancy, how we calculated that? Same material standard quantity into standard price of material, actual quantity into actual rate. Here, instead of that quantity, standard hours we are taking. Instead of that price, here standard rate per hour rate we are taking. So standard hours into standard rate minus actual hours into actual rate. And measure of overall labor cost variancy. This labor cost variancy will give that measure of overall labor cost variancy. Next one is the labor rate variance. Labor rate variance, how we are going to calculate the difference of rate. The difference of rate, what? The standard rate and actual rate. So the standard rate and actual rate difference we are going to take, it will be multiplied with the actual hours. Then you will get the labor rate variance. So due to the wage rate difference, we are going to calculate the labor rate variance. Next one is what? Labor efficiency variance. So instead of that usage variance in material usage variance, in labor variance, we are going to calculate the labor efficiency variance. So in labor efficiency variance, before calculation of that, we have to take the difference of hours. So standard hours and actual hours, we are going to multiply with the standard rate. So due to time efficiency or inefficiency, to calculation of this efficiency, we are going to calculate the labor efficiency variance. Next one, third efficiency model is overhead variance. Overhead variance talks about that cost includes both fixed and variable overheads. This variance are calculated the control production overheads. So first variable overheads we are going to take. So variable overheads, the measure of difference between standard and actual variable overheads, it includes spending variance and efficiency variance. In second case, fixed overhead variance. In fixed overhead variance, measure of differences between the standard and fixed overheads with the actuals. So it includes actual expenditure budget variance and volume variance. So it is also includes that efficiency variance, capacity variance, and calendar variance. And next one is the sales variance. Sales variance talks about the theory. Sales variance talks about the theory used in the revenue sales forecasting and performance measures. The sales value variance to calculation of sales value, actual sales minus budgeted sales. You will get the sales value. That sales price variance is actual price and standard price and actual quantity, whatever we sold, you will get the sales price variance. And sales volume ratio, actual quantity and standard quantity, same, it is similarly that labor and material, here based on that situation, we have to take the formulas. So here sales value formula, actual quantity minus standard quantity. So it multiply with the standard price, you will get the sales volume ratio. So this is the different various variances which we have in our syllabus. So before examination, just you go through the syllabus, you prepare according to the plan only. So in for black number 1, it is talks about the introduction. In this black, purely theory questions will come. The theory questions also very important. That is the relationship between management accounting and financial accounting and cost accounting. And also here important topics are important functions are, that is management functions and scope of the management accounting. These two questions are very important. So functions and nature and scope of the important also very important in black one. In financial statement analysis, this black talks about the financial statement analysis, black 2. So there are 2 units, introduction to the financial statement and methods of financial statement. There are the problematic part will cover from this black 2 only. You better to focus on the financial statement, profits and finance flow and cash flow statement. From these 2 topics, there is the one problem, there is a chance to get. And another one is the theoretical part they are going to cover. And methods of financial statements also. Financial statement, comparative financial statement and common size and comparative statements and trend analysis. So from these 3 questions, 1 question they are going to ask from the unit 4. And financial statement analysis 2, ratio analysis and funds flow statement analysis and cash flow statement analysis. So whatever that black 2 theory part is there, here problematic part will cover ratios related and funds flow related and cash flow related. So if you learn that whatever illustrations are there, whatever example problems are there, if you focus on at least 2 problems from each unit, you will able to write the examination also. And marginal costing decisions and marginal costing budget control decisions also. There is a one question from problematic and one question from the theoretically. So in that marginal costing questions, just you have to learn the formulas. You have to learn that formulas and you do the practice. And in budget control, the important topics are flexible budget and cash budget. And the flexible budget and cash budget only very important topics. From these two topics, there is a chance to get the problems. So remaining same problems, same topics, theory questions also they are going to write. Light. So next one is the last two unit in for last black after the budget control, standard costing and variance analysis. So whatever I discussed just now, that only it will going to be covered, and it is only theory part only they are going to ask. So the 12th unit and 13th question theory part only will cover. So better to focus on this, and all the best.